Tesla beat expectations, and yet the stock is down 4% after hours as of the recording of this video. Everything I warned you guys about in my last two videos is coming true. Now, if you're going to make money during this earnings season, you have to understand what's happening. And understanding why Tesla is down after beating earnings expectations will give you a much better rational understanding of the stock market and can help you make money instead of lose money. I've been saying for the past few weeks, it's a good time to take profits on the mega cap tech stocks. And today is a great example why. So let's talk about some of the earnings that came out today, some of the stocks that rallied, some of the stocks that sold off, and most importantly, we have to talk about the mega cap tech stocks, what Tesla earnings mean for the rest of the mega cap tech stocks, and how you can play it to actually make money so you're not losing money gambling on calls and puts. Let's start with the bank earnings that came out earlier today because bank earnings give very good insight into how the overall economy is doing. And Goldman Sachs missed on profit after hits from their green sky and real estate deals. In other words, Goldman Sachs made money on their overall interest because of higher interest rates, just like every other bank did. But Goldman Sachs made some bad trades on the quarter, and that's why their earnings were amiss. Still, investors overlooked those bad trades, and the stock was up about 1% on the day and down about 0.2% after hours as of the recording of this video. Now, the biggest thing that we've been waiting to hear from are the regional banks. These are the banks that everybody had major concerns about going under and collapsing. And one of the biggest ones that people had concerns about was Zions Bancorp, and they reported today. Zions Bancorp stock jumped as deposits rebounded and profits beat estimates. Now, this is excellent news that Zions Bancorp's profits have rebounded because, and most importantly, that their deposits have rebounded because that means that all that money that was pulled out of the bank, people are starting to put that money back into the bank. This is going to shore up their balance sheet. This is excellent, excellent news for Zions Bancorp and just regional banks in general. Zions Bancorp was up 6% on the day and then rallied another 8% after hours. But the biggest winner this earnings season is one that nobody saw coming. An absolute shock. A company that was on the verge of bankruptcy had a major announcement when they released earnings today, and it sent the stock skyrocketing. Carvana shares jumped after they announced a deal to reduce their debt by $1.2 billion. Essentially, Carvana is added to the list of companies that have bad debt write-offs. What's happening here is that the lenders have agreed to write off some of Carvana's debt, as well as restructure some of it as well. This is a pretty big hit, a pretty big loss to the lenders, but it's good for Carvana and helps them stave off bankruptcy for now. And investors loved the fact that Carvana was able to write off $1.2 billion worth of debt. And that news sent Carvana skyrocketing up 40% on the day and another 6% after hours. United Airlines was another company that posted record earnings and strong profits as they forecasted an incredible summer quarter. United stock was flat in the day and up about 2% after earnings. Now moving into the technology stocks, IBM reported an earnings beat but missed on revenue. And this is pretty common. We've talked about this, how companies are doing layoffs in order to reduce their expenses. And so long as their expenses go down by more than their revenue goes down, they can increase their earnings. And that's exactly what happened with IBM. They missed on revenue, but because they were able to reduce their expenses by more than their revenue dropped, they were able to beat on earnings expectations. Overall, though, market was fairly unimpressed. IBM stock was flat on the day and fairly flat after hours. Now it's time to talk about the two mega cap companies that reported earnings on Wednesday, and we're going to get started with Netflix. Netflix earnings had a massive increase in subscribers, but the stock fell after hours on a light revenue forecast. Netflix stock was fairly flat on the day, but then fell 5% after hours. It was actually down 7% as of the recording of this video. Netflix subscriptions jumped 8%, and their revenue climbed as their password sharing crackdown took hold. And this is good news for Netflix. We want to see those subscriptions up because Netflix makes money on subscriptions. Revenue came in line with estimates at $8.2 billion versus $8.3 billion expected, but Netflix actually blew away earnings at $3.29 a share versus $2.86 a share expected. Now, Netflix beat earnings expectations, revenue came in line, and even though Netflix had a massive beat in earnings, their stock was down 7% as of the recording of this video. So what is going on? Why did Netflix stock drop after they had an earnings beat? It doesn't make any sense unless you watched my last two videos. If you watched my last two videos, then this makes perfect sense. In my last two videos, I explained how the mega cap tech stocks are priced to perfection. How these companies with these forward PE ratios of 80 and 100 and just insane forward PE ratios would essentially have to show the most insane earnings and revenue growth that they've ever showed in the company's history if they want to maintain these extremely elevated stock prices. And anything less than insane growth and basically perfection might cause the stock to go down. Because when your stock price is priced to perfection, it doesn't matter if you beat analyst expectations. If those earnings aren't perfect, the stock price is more likely to go down than up. I mean, after stocks have rallied and doubled and tripled in the past 9 months, it's far more likely they're going to go down than double or triple again. And this is exactly what we saw with Netflix. Netflix hit a new 52-week high today on extreme optimism, only to fall after hours after reality bit investors. And Tesla had a very similar story. Tesla booked record revenue of $24.9 billion, even though their margins did decline after they cut prices on their vehicles. Tesla's revenue came in at $24.93 billion, a massive beat to the $24.47 billion that was expected, and earnings were another incredible beat at 91 cents per share versus 82 cents expected. Yet, even though Netflix had a massive earnings beat, the stock did not rally. The stock was down 0.7% on the close, and as of the recording of this video, Tesla stock was down 4% after hours. This comes despite Tesla reporting a 47% increase in sales in the second quarter. So if Tesla beat earnings, why didn't the stock rally? Well, as I explained in my last two videos, even though the results look solid, it's not quite good enough to keep the stock moving higher in the coming days. And one thing that investors really did not like is the fact that new car prices and profit margins slid for the second quarter in a row. Gross profit margins in Tesla's car business, excluding regulatory credit sales, came in at 18.1% versus 18.8% in the first quarter of 2023. First quarter gross profit margins fell 11 percentage points year over year amid steep price cuts implemented by Tesla at the start of 2023. And this is what I explained in my last two videos, is that as inflation starts to come down, this cuts into company profits. And this means margins go down, which means earnings go down. Even though Tesla saw this massive, insane revenue that was 47% higher year over year, they actually saw earnings continue to go down. And even though this beat analyst expectations, As I explained in my last two videos, Tesla is currently priced for a 400% year-over-year earnings growth. They have failed to do that. Earnings are not growing at all. In fact, they're going down. Now, earnings are up 20% year over year, but it's just not an improvement over last quarter. And unfortunately, this is not good news for Tesla. Tesla has failed to report the 400% earnings increase that the stock is currently pricing in. And because Tesla is priced for a 400% earnings increase and they only got an 18% earnings increase, well, obviously that is 8 times worse than the market is pricing in, and the stock unfortunately fell after hours. And this is what I've been trying to explain to you guys in the last few videos, is that even though the market is exceptionally bullish right now, the mega cap tech stocks are priced so high, and they're pricing in the most insane, incredible earnings growth in the history of the United States. And anything less than that, even if it beats analyst expectations, causes the stock prices to fall. So I get being bullish on stocks, but thinking that stocks are going to continue to double and triple in price after they've already done so is, I hate to say it, but kind of insane. These stocks are far more likely to come back down to the earnings that they're currently delivering. And that means some very significant decreases in the stock prices. Now, while the market remains extremely bullish and extremely exuberant, there is no possible way that the mega cap tech stocks are going to come down to fair valuation. But it is something that could happen over the next 2 or 3 years. And it's very, very possible that if you don't take profits right now, you could end up in the situation that investors were in the early 2000s, where they had to wait 14 years to break even on their stocks. That's right. If Tesla isn't able to pull off a miracle and start increasing earnings, you might be waiting 14 years to break even on your investment if you continue to buy Tesla at $300, $400 a share. It doesn't feel good to say that, but that is the reality. Now, Tesla is perfectly capable of turning things around and increasing earnings. But right now, they just don't have a path to do that. They're not showing that. That's not what they're actually delivering. It would be great if it happened. It's just not happening right now. And this is a huge red flag for the other mega cap tech stocks, Apple, Nvidia, Microsoft, all the others, that if they are also not able to deliver on the insane valuations that they're currently priced at, they're going to end up coming down too. So I want to repeat, the biggest mistake that people made in early 2021 was not taking profits. Take profits now. Don't be so foolish to think that these stocks are going to keep rising when the forward PE ratios are at 80 and 100, especially when the average forward PE ratio on the S&P 500 is 18. A stock that's priced at a forward PE ratio of 80 is going to eventually, more than likely, come back down to the forward PE ratio of 18 to 20. And it's very likely that as these stocks continue to miss and continue to deliver the expected earnings instead of the insane earnings that are currently priced in, that these stocks are going to start to fall. So you want to know when to take profits? Take profits now before they fall back down to more reasonable valuations. So that's my rant. Now let's talk about the economy. Canadian port workers are back on strike after voting down a government brokered deal, returning supply chain to turmoil. Don't forget that the supply chain issues are what caused inflation in the first place, so this is bringing renewed worries that inflation might start creeping back up again. And as I just warned you about in my little rant I just went on, tech stocks, meme stocks, crypto, investors are feeling bold again. The market looks a lot like it did in early 2021, right before stocks entered a deep slump. Bullishness among individual retail investors is the highest it has been since November of 2021, right before the massive crash of 2022. Market contrarians say the perfect storm is brewing for a crash. Retail investors were similarly euphoric in late 2021, but by early January 2022, all three major stock indexes had peaked, and the S&P went on to lose 19%. The FOMO, or fear of missing out, becomes so great that retail investors come clamoring in at the end, the last hurrah, just in time for the market bottom to fall out. Retail investors have a long history of becoming extremely bullish at the top of a market, only to get killed and clobbered when the rug pulls and the market very soon thereafter falls. And it's not just the exuberance that's giving some cause for concern. Higher borrowing costs threaten to slow down the economy, choke off credit for businesses, and make it harder for companies and households to get loans. I talked about this in yesterday's video, how the credit crunch is going to stop these growth stocks from realizing the kind of growth that they realized over the past 13 years. And of course, we're already seeing that in some of the earnings from companies like Netflix and Tesla. And we're very likely to see that in the earnings of the other mega cap tech stocks next week as well. Also, don't forget that while inflation is eased, it's still well above the Fed's target of 2%, and Fed officials are likely concerned about Americans getting used to elevated inflation. If we get stagflation, rates will have to continue rising, and that is not good news for investors. And look, when it comes to earnings, if you want to play the actual individual earnings move, that's fine. But you should know that when you play earnings, you're basically gambling. I don't really like to play earnings at all because it's gambling. You literally have no idea what a stock is going to do after they report earnings. You can guess, you can hope, but you don't know. When we trade stocks, we're trading based upon known information. We trade upon information. So if I'm going to trade earnings, I'm going to trade the day after earnings. I'm not trading on the actual earnings. That's gambling. And look, if you want to gamble on stocks, that's fine. That's fine to gamble on earnings. I'll admit, I buy a few very, very, very small put and call options here and there on earnings. But I'm always, every single time I play earnings, I know that I have like a 99% chance of losing the entire gamble. So that's fine. If you know you're doing that, just admit you're gambling. The thing is, I got a better gamble for you than earnings right now. The lottery. The Powerball jackpot's at $1 billion, and the Mega Millions is at $720 million. I mean, seriously, you could put $2 onto the Powerball and $2 onto the Mega Millions for a chance at $1 billion or $720 million. That's way better than you're going to do in the stock market. You put $2 on an option in the stock market, at best, you might hope for that to go into maybe $4. You want to gamble, go gamble on the lottery right now. Serious, I'm dead serious. I actually bought lottery tickets today. Like, until these winners come up, it's probably a better gamble than earnings. Anyway, I just wanted to give you guys a couple of other options for gambling outside of the stock market. But if you don't want to gamble, just wait for the earnings to actually come out and then make your plays. All right, guys, I hope this video helped you out a lot. If it did, just be a good friend, share this video on the social media pages, hit the like button, subscribe to the channel. And if you missed the video that I went over yesterday, it's like a 30-minute long video where I do a deep dive into the economy, what's happening, why stocks aren't rallying after earnings. If you missed it, you're probably not going to like it, but you need to hear it. Go watch yesterday's video so you can get some insight and understand why these stocks aren't rallying after they're beating earnings.